All right, I think we are live. Hey, everyone. Today I'm joined by Nick, co-founder of Derive, which has been a long-standing roll-up L2 built on top of Celestia. And today we're having Nick on because they just posted some really impressive growth stats, and they have a very exciting roadmap that ties in really well to Celestia's scaling roadmap and the North Star of 1 GB blocks. So Nick, why don't you give us an intro of yourself and tell us a bit about what Derive does before we jump in?
Yeah, sure. So thanks for having me on, Nick. I'm also Nick, co-founder of Derive. We used to be called Lyra. I used to be an equity options trader at a Wall Street firm, so market making like stocks in the US market. And we've been building Derive for almost 4 years now. And our goal, we're kind of the largest on-chain options DEX. And our goal really is to provide derivatives liquidity at scale with trustless margin clearing and settlement, because once we do this, particularly with options, are the most programmable financial instruments. So you can start to create all sorts of interesting and creative products on top of this bedrock of liquidity, both in options. We support perps trading, spot, and some lend borrow stuff as well. So we have the full factory for finance that we're spinning up on chain, and with sufficient scale and liquidity, you can really start to innovate on the UX level and also in the products that can be created. So, we've been growing very quickly over the last few months, working with Celestia and trying to really push the boundaries of what's possible with on-chain compute.
Yeah, I think some of the first adopters of Celestia were on-chain options protocols, because I think they're so data hungry that back in the day, they really needed most direly like an alternative source of DA that was cheaper than Ethereum. We'll touch on that in the future, but part of the reason why we're talking today is that you guys crossed a major threshold, which is you had over $6 billion in volume. And there are a bunch of other stats here: 101 million TVL, over 60,000 users, and 680K transactions. So some really, really impressive growth from my perspective. What do you think has driven that? And tell us the story of how have you gotten to where you are? Because this is some really impressive stats.
Thank you. Yeah, it's been a grind. It's not easy. So I think the first thing that we found, we've been building in the space, as I said, for almost 4 years. And back when we started, the tech was very limited. This was 2021. People didn't even know what an L2 was when we first launched. I think we were the first to launch natively on Optimism, the first team. So we were constrained. We used an AMM that wasn't very capital efficient. And we've kind of been iterating on the design, and we launched the newest version of the protocol in January this year. And really with kind of an inauspicious start, I think we had a couple million TVL. But it was much more capital efficient, very high performance, portfolio margin, all of these features that you kind of need for options. But with an exchange and with liquidity, it's very, very difficult to just sort of start at like a low level, like 3 million in TVL and small amounts of volume, and just instantly gap up to major success. The way you grow liquidity is you bring in some liquidity to start with, you get some trading activity, then that begets more liquidity, and you continue layering those things on each other until you can start to really scale up at in a sort of big, large way. And of course, we've been iterating on the product itself, launching new assets and collateral types. And the real unlock for us over the last 6 months has been the ability to build institutional, sort of scale trades on top of collateral that is somewhat underserved across the crypto market in centralized exchanges or decentralized exchanges. Collateral types like EtherFi's WEETH, restaked ETH, or Athena's USDE, SUSDE. We were some of the earliest adopters and building products on top of those forms of collateral. And now more recently, the BTC-Fi space with Lombard, we've built structured products, and we have large users, whales, institutions, as well as retail coming in, posting these collaterals, making big trades on top of them. Just last week, we had one LBTC holder go generate in one trade $1.7 million in sort of yield and premium by selling some Bitcoin upside. And these are the kinds of different differentiators versus, say, just a vanilla perps DEX, right? where you can do a couple of things. You can bet on something going up, you can bet on something going down, you can maybe harvest the basis. But that really is a more limited set of tools. And perps are great. They're a fantastic trading experience. But what we're trying to do is really build out this full set of functionality around each different collateral type. And that started to get some traction, and which is what's really been driving both our TVL and volume growth, is going to new users, new communities, building utility on top of that collateral that they can't get anywhere else. And then traders see that, they come in and they start making trades.
So it's a combination, it sounds like, of new collateral, but also new functionality that you couldn't do on a lot of the other dexes that exist. And like you sounds like you're targeting even like more, I wouldn't say institutional, but like replicating the kinds of things that you could do in like a full suite TradFi off-chain environment, but doing it on-chain. Is that fair to say?
Yeah, that's right. It really is like the full financial like arsenal. We just kind of equip collateral types with the full like power that you would really get in traditional finance. And whether that's for speculation, you can speculate very precisely with both perps and options, whether it's for yield generation or hedging use cases. It's much easier to sort of coordinate and build these trades for tens of millions, hundreds of millions of dollars using options than it can sometimes be with perps as well. So yeah, that's been really what we do. It's the most powerful financial arsenal on chain available, Derive, and people are starting to take notice of that. And that would not be possible if we didn't have the compute backing it. I think a lot of the things that we do specifically and uniquely at Derive, this cross function, like cross margin between options and perps, right? You can sell a call, which is essentially shorting the upside, and then buying a perp, cross margining those things. There's a lot of math that goes on chain behind the scenes to make that super capital efficient and performant. And for us, one of the guarantees that you get when you trade on Derive is that everybody gets the same rules. The margin system is on chain. It's fully verifiable. It means that we can't extend margin to like a market maker on the back end, because there is no back end. The back end is the protocol with respect to the margin risk settlement and clearing. But in order to do that in a really performant way that can mirror, what people are used to off chain and in traditional finance, you need a lot of compute. You need financial models, equations like Black-Scholes, all sorts of scenario sort of testing and analysis for portfolio margin. And that's where really we've leveraged Celestia to the fullest extent. It's why you see us using a lot of the space and high amounts of block space relative to some other applications that might not be as financial or not as involved.
Yeah, that's a good segue to the history of how Derive migrated to Celestia for DA, and also looking forward into like where you guys are going, and in general like the DeFi, on-chain DeFi, I guess, space and options specifically. So like as I mentioned earlier, there was Derive, there's Orderly, there was Avo, like sort of a suite of these like derivatives options platforms that in the early days of Celestia were some of the first to adopt Celestia DA. And I think that was because essentially they're so DA hungry, because as you said, options are a lot of math. There's an extraordinary amount of math going on. Gas costs on chain on Ethereum are way too high, so you make an L2, but then the DA that goes behind that into the calculations is also too expensive. So you needed a lot of scale essentially. So yeah, Derive was one of the first L2s to migrate over, and I'm curious, just like from your perspective. I mean, those are also in the days where applications like that were saving millions of dollars, sometimes like on a monthly basis by switching from Ethereum call data. Now that's no longer really the case because of 4844. More congestion seeming on the horizon for 4844, whereas Celestia maintains like greater and greater scale. So I don't know, I'm curious, like, how do you see the role of data availability, the role of Celestia in your guys' roadmap and your evolution as a product, from like around a year ago when you first migrated?
Yeah, I mean, I think really the sort of table stakes were, as I mentioned, this idea of having all of the margin risk settlement clearing on chain, and doing so in a performant way. Ultimately, I think the lesson that the industry has learned at large is that users are not going to compromise on performance, capital efficiency, and at the end of the day, the amount of dollars that they're sort of putting up to make a trade, whether it's in fees or in capital terms, they're just going to use a centralized exchange instead. So you have to get to that level, and that's kind of where we've gotten to over the last year, and using the protocol and using Celestia. I think going forward, we can now really start to outcompete centralized exchanges on the sorts of kind of tech that we're going to be building into next year. So some of the potential avenues that we can take involve really pushing the boundaries of what you can do with on-chain compute in terms of high performance market making algorithms like AMMs. We used to build AMMs back in the first 2 or 3 versions and iterations of Derive. Back then it was called Lyra. We actually had a profitable AMM for an entire year throughout June 2022 to like July 2023. Just during the FTX collapse, it returned 8% in USDC terms. But that was with a super basic algorithm, and ultimately, like, it didn't scale that algorithm. But into the next year, we think we can play a really significant role in compressing this gap between, sophisticated market makers and ultimately retail participants by, like building these algorithms that are accessible for retail in terms of market making and providing liquidity, earning a delta neutral yield on their capital. Because ultimately, my stance is that liquidity is fungible, like globally. And that's why I love the blockchain. It creates fungibility for liquidity, no matter where you are in the world, like what your background check is, what your credit score is. If you have $1 on chain, you can go put it to work and make money from it. So I think teams like ours kind of have a responsibility to try and level the playing field in terms of, sophistication and information access. And I think there's this whole design space that we're beginning to explore, where, as I sort of have mentioned to, kind of sometimes in the past, market makers in the industry in crypto tend to demand, 80, 90, 100% APY on their capital. Retail at the other end, like, are happy getting a risk-free rate plus, 5, 10, 15% on their capital, as long as it's delta neutral. That whole design space of, okay, you've got maybe 20% on retail stable coins, and then market makers who require 100%. That's the margin that market makers charge, and that's how they outperform. And that's where I see opportunity. I can't tell you we've worked out exactly how this is going to look, but I know that with the availability of like increased on-chain compute, potentially some ZK technology that can obfuscate the exact algorithm so people can't game it and back solve for it, you can start to build some very interesting AMMs, both for options and perps, that democratize this ability to generate alpha off of liquidity and take risks. Because ultimately what these market makers are doing at scale is providing liquidity. They're providing a service, they're taking risk. And the blocker for retail isn't so much the risk appetite, it's the ability to make those quotes and not get picked off. So for us, if we can leverage more on-chain compute and some of these new technological breakthroughs that are coming to really democratize that process and compress that margin 100% to 20% APY, that's a massive opportunity, and it will help our liquidity. It'll be a better product for our users, and ultimately kind of evolve the financial markets beyond kind of the status quo that they've been in for 20 years. And it really leverages the blockchain to democratize that opportunity. So we're excited to play in that space. It's going to require a lot of compute, but it's definitely a big theme for us in 2025.
So it's like your margin is my opportunity. You guys are kind of saying that to these derivatives market makers, essentially.
That's right.
Wow, that's super ambitious. I've actually heard of other projects doing similar things, but every time I like looked into it, it was like custodial or just like, yeah, you're basically just giving your money to some other market maker guy to make their own algorithm or whatever. So this is gonna be interesting to see, and I think that this really touches on one of the core themes of what Celestia is about, which is like taking what it has traditionally been off-chain and actually putting it on-chain. And like, I think we've been conditioned to just think that a lot of these things are just never going to be feasible to run on chain, but actually, where we're going and the kind of throughput that we're going to have in terms of data availability, the kinds of things we're going to be able to prove with these novel ZKVMs is going to mean that, there's, I'm not going to say there's no limit, but the scope of things that we can do on chain is just so much more vast than what anyone's really conceiving of right now. And where's all this demand for DA going to come from? It's frankly, like, I think there's going to be a dramatic amount of induced demand for that reason, of just entirely new capabilities, entirely new applications being opened up. And it sounds like Derive wants to be at the forefront of like taking advantage of those, this new like frontier that's opening up.
Let me tell you, I'm so freaking excited for what's happening in the next couple of years, and particularly within this whole Ethereum ecosystem. We've spent the last 2024 really, like, as I said, it's table stakes, the stuff we've been working on this year, like making great liquidity, like super performant margin settlement clearing, and now building up this layer of liquidity, layering on trades, layering on TVL, bringing in new users, finding the wedge that we have against centralized exchanges and the ability to activate these collaterals. That gets us to where we are now, where we have this big network of potential trades you can make on Derive. You can earn 13% on your USDC at the moment by depositing, just based on the stuff people are doing. They're borrowing and putting it to work in lots of other ways, both from the borrow lend market, from our options, from our perpetuals, from our spot markets, and some of the on-chain structured products, which I think are the kind of the first form of this high performance self-custodial strategy angle that we're going to be going for. But this is table stakes. What we really want to build to is taking all of these new technology developments that are dovetailing at like the right time as we've hit sufficient scale, with our liquidity and the sort of basic setup, to really leverage and innovate in the market. And that's, we've got a bit more time to do that now that we can pull our heads up from really grinding these flows, and stacking them on top of each other. We can take some time in 2025 working with some of these crazy teams that are pushing the boundaries of what's possible, both from a perspective of what's doable on chain, and then also what's doable in finance, to rethink how markets should work from first principles. And that's what I'm really, really excited to do next year.
Well, we're also talking on a very auspicious day, which is the Ginger upgrade just hit Celestia mainnet. So for those who haven't heard yet, Celestia block times just dropped from 12 seconds to 6 seconds. So we have, twice as fast finality and twice as many blocks. So we have 2x throughput. And then baked into Ginger is actually the ability for the network via a on-chain governance proposal to upgrade the block size from 2 megabytes to 8 megabytes. So in total, if you add those two things together, we're scaling the block size by 8x, which gets us to 1.33 megabytes per second of DA throughput in total. And this is all part of like a much larger scaling roadmap, which is under the North Star of gigabyte blocks. And earlier this year, we published this Mammoth mini testnet. You've probably seen a lot of mammoths running around on Twitter. You guys have your own little horse emoji, which I love too. And essentially, I bring all that up because, the reason that scaling matters so much is like, we want to make sure that you guys don't ever have to think about scale. Like, we want to make sure you don't ever hit gas limits or DA limits and start having to, gas golf or optimize. Like, you can just focus on what you do best. And so, yeah, I just wanted to ask you, from your perspective, what you think of the Celestia scaling roadmap. How does that inform like your choice as a builder to choose Celestia, and where do you see that like aligning with where you guys want to go in the long term?
Yeah, I mean, I guess just on the block limit, the size of the blocks, I would say we're probably one of the first teams to really discover this problem in like a really practical way. We could really feel this problem when we were building in 2021, 2022, because we were always doing all of this stuff on chain. It was just in a slightly different format. With the AMM, it had to calculate options prices on chain. And so we would actually have to modify what we could do with the code in a meaningful way, reducing the capital efficiency and the performance, because we're running up against
smart contract, right? You guys were initially building like on Ethereum L1, not even as an L2. Okay.
On an L2. This was on Optimism. We were hitting the
on Optimism. Okay.
Yeah.
Even Optimism, it was too expensive. That makes sense.
That's exactly. Yeah. And so like the first, we kind of got going in very early 2021, and we immediately knew we couldn't do this on L1. Just because of, I think we did some calculations of it cost $1,000 in gas per trade or something. So we knew that it was just not possible. So we went to L2, and even then, with the computation we were doing, it was like we had to reduce, really trying to optimize the code we'd written to make sure that we were kind of coming under this block limit every time. But even then, we still had to cut a bunch of functionality out in order to make it work. So that's where we've come from, and we feel that very viscerally, and we kind of have felt that very viscerally, throughout our history. And now we're at a point where, as I said, it just feels like not only like is the technology getting to a point where we don't have to be constrained by like these sorts of like on-chain considerations and things that you have to make compromises for being on-chain versus off-chain, but there's a whole host of tooling and interesting functionality that and then also, of course, just existing in this on-chain space now, where you can really start to get creative and think, okay, what can you do with like this idea of a global financial settlement layer and fungible liquidity globally, and the fact that you can actually build in this space where potentially you can offer 30%, you can build a product and an algorithm that generates 25% APY delta neutral. Obviously, like that's a huge feat in itself. I don't want to make it seem like that's an easy thing to do, but you can build these sorts of things that were previously not possible from this combination of having high performance off-chain like compute and being in this public fungible liquidity, much more democratized marketplace sort of world that we're in. And that's really when you start to marry the two and can begin to change how finance works. And I think a lot of financial firms, both on the exchange side and in the market making side, are due for their Kodak moment in the next 3 or 4 years. And I think some of them are starting to realize that at the moment too, just based on just the speed at which things are iterating. I mean, my God, like we started 3 years ago and it was impossible to do almost any of this stuff. And now we have really the arsenal and the weaponry behind us in the form of Celestia, and in the form of the capital that's accumulating, the assets that are being issued on chain, to really make a strong go of it.
Yeah, I love those are fighting words. That the TradFi is going to have its Kodak moment. I love that. I guess to transition here, like what is your guys' ambition? I mean, I've always been, people complain about, oh, there's no real applications or use case for crypto. I really feel that a lot of the original use cases are the things that are gonna just haven't taken off yet, partly because just the right recipe didn't quite exist yet. There was still too much friction, either with the infrastructure or with there weren't enough assets, like you said, or there weren't enough, or like the wallets and the onboarding was too difficult, or who knows. There was just so many different things that needed to come together to unlock, the proverbial mass adoption, which I hate using that, but for lack of a better term. And I feel like that recipe is starting to come, and those pieces are starting to click into place. And like, clear use cases like payments. We're a big fan of Pay, which is a application built on Celestia that just, all it is private stablecoin payments. I think that's enough to be a killer app. DeFi is another thing that's just so obvious. It's like, blockchains, I think they're a lot more than just asset ledgers or whatever. But like assets are, and finance is just such a natural fit for blockchains. So it makes a ton of sense to me that like the future of finance is going to be built on chain. So anyway, as we close out this stream in the last few minutes, like, what is your guys' ambition for Derive? Like, where do you guys want to go from here? Like, help us dream really, really big on the scale of gigabyte blocks.
Yeah. So the original insight that we started Derive with in late, like when we were first iterating in early 2020 on the idea, was that options are a natural fit for this programmable financial environment that is the blockchain. Why? Because they are like the most maximally expressive financial primitive. You can create any payoff out of different calls and puts. And the cool thing about that is that when you boil it down, if you have a specific opinion about markets, about where the world is going, how things are going to be moving, if you express that opinion precisely, which you can do with options, like, so instead of I think Bitcoin's going up, it's I think Bitcoin's going to 120K in the next 3 weeks. you can express that opinion more precisely and make a lot more money. You can be more right, and really sort of capitalize on that. And this was the insight, is that like, okay, you do these things at scale, you can create all of these different financial payoffs, infrastructure, to support options, perps, like really liquid abilities to express opinions about the state of the world going forward. I think prediction markets also have a role in that. But the cool thing about that is once you have that liquid and live and at scale in this public environment, you can really create what I like to call, and that some people on my team don't love as much, is this framing of the infinite payoff factory. Like you can really create any bet, any expression of like how the future is going to look, and you can be, as you can generate yield, speculate, and do all of these things at scale. So for us, our goal is to really, make that functionality as widespread as possible. The tailwind that we didn't expect, though, that has really started to come into play over the last 6 months, and the barrier to entry for options more generally, is that they're complex. They're more difficult to understand. In the same way that they're more powerful, that tends to come with increased complexity. And a tailwind that we're looking very closely at for 2025, alongside democratizing the ability to make money using your dollars and liquidity, like with market makers, is this idea that on-chain AI is a specifically fantastic fit for options because they are so expressive. The downside for options is their complexity, but that complexity and reasoning through those things is not going to be a problem for on-chain scaled AI agents who will prefer power and precision over something more blunt, like a perp with 3x leverage. So once we have this infinite payoff factory at scale, we can begin to abstract away the underlying derivatives and components, and people can interact with that liquidity and the underlying derivatives in a much more intuitive way, where they can understand the risks, they can understand the rewards, but they can say something like, here's my trading opinion. I think, Bitcoin's going to 150K, or I think Trump's going to win the election or lose the election, and this is going to happen. And it can start to recommend, you can start to express those opinions natively with one click, as opposed to having to go and open up the order book and pick out a different option. So both from a UX perspective, as well as potentially compatibility with agents that are making trades themselves on chain and executing strategies, we think we're assembling like the most powerful backend for these functionalities and for these different applications. And really that's, I think, what we want to do is just continue to focus on our role as making this liquidity layer as performant, as secure, and as trustless as possible, so that no one has to actually kind of check whether a market maker is solvent or worry about any of these things. They can just integrate with that liquidity directly and express views precisely about what the future is going to look like.
So what you're describing is, I'm just some normie with no finance or options background, but I have a prediction or I have a sense for the trade that I want to do, or the kind of bet that I'm trying to structure. And, an LLM can essentially take that input. I could just like speak it, type it, whatever. And then they could say, hey, this is the trade that you should put on. And it's like some kind of straddle with, I don't know, all those like weird options, like terms. And so that someone can actually, like, basically you're making options a lot more accessible to a normal person.
That's right. But it's more than just options. It's like this whole idea of we've got the most powerful financial arsenal on chain on the back end. And this interface can go, and the AI can pull, really from that arsenal and construct it given what your preferences are, whether it's a expression about what you think the future is going to look like, or a particular hedging need you want to get done, or an amount of yield you want to generate. It can go and construct that for you, bring it to you, serve it up, and you can get that done and execute in a performant way. That's step one. That's actually something that I think we're going to have, and we're working on from a product direction early next year. It's not going to be, this isn't some like far off thing. But the next step, of course, so phase one is just making and improving the UX and kind of having an AI first trading interface in of itself. So more details we'll have live about that in the coming weeks. And then step two really is this idea of on-chain compatibility directly with these agents and these teams that are building, sophisticated algorithms on-chain. And as I said, complexity is not going to be a barrier for those algorithms, for those models. What will be a barrier is the ability to win as much, to make as much money or express their opinion as precisely as possible. And ultimately, it's just not something you can do with an instrument that's one-dimensional. You kind of need all of these different financial instruments on the back end to make this a compelling product.
Wow. Well, thank you, Nick, so much for coming on today. now that I've heard a little bit more, I mean, I'm not surprised by the tremendous growth that you guys have had recently. Looking forward to Celestia continuing to supply you guys all the abundant block space that you need with this ambitious vision for even more on-chain liquidity, even better sort of like strategies for vaults, essentially for normies to market make and earn yield, and for on-chain AI driven options. This has been a super exciting conversation, and looking forward to see the future growth into 2025.
Appreciate, really enjoyed this conversation, and yeah, of course, all of the support. It's been super fun working with Celestia and you guys, and yeah, looking forward to really crushing it in 2025.
Cool. Well, thanks to everyone for tuning in. We'll see you next time.
Thanks.